Most people do invest without knowing whether they are getting return or they are not. Now, today, we want to discuss and enlighten you how inflation can help you or can guide you to know which kind of investment you should take, either A or B. But yeah, that is going to make the essence of this discussion today. So please stay tuned. And with my co-host is Efe Juma. Stay and watch. Efe Juma.
Yes.
Welcome back.
Thank you, Kolakodek.
Yes.
You've mentioned a very important point. Most of us don't really factor in inflation into
the investment they are making.
Investment decision. That time that they are thinking of making the investment decision, they don't usually factor in inflation element.
Yes.
Then that end up leading them astray.
Very true.
You understand?
Very true. I've seen some instances that people think that they're investing, but not knowing that this kind of investment, when they do, they calculate the interest that they are getting. At the end of that particular period, it has only fought the inflation. There is no investment.
Leave alone investment. Even saving itself.
Yes.
You know there is a difference between saving and investment.
Very true.
Majority don't know. Can you tell them the difference?
Of course, a saving is one that you are just preserving or reserving the amount that you are having, while an investment is something that adds on top of what you had. A simple
that is
difference.
Your definition for
there's a simple difference of saving and investing.
It's okay. That one, it means you are defining, you are differentiating, basing your argument on conservative. Is it conservative or aggressive? Okay. Which that is, I can say, it's somewhere there. But basically, if you want to compare savings and investment, what you really look at, what you should really look at is the rates. Okay.
So what is the difference between saving and investing?
So for savings,
for a layman
person, savings is you are having sure rates. Okay. So if it is 10%, you know it is 10% throughout. So that's why it is conservative in nature. You can plan with it. For example, things like school fee, you put in a savings. Okay. So that you are sure that if it's 10%, it will be 10% throughout. But when you come to investment, it's now return is not guaranteed.
The rate is variable.
The rate is variable. It is having a floating return. Okay. So that is the difference between savings and investment.
So today it can be high, tomorrow it can be low.
Yes. And now we come up with what are the rate of return. When you talk about investment, you talk about rate of return. Why are you asking? Because it is variable. It's something that is varying. But when you talk about savings, you're putting somewhere where it is safe. Okay,
you are sure that
it is
that
there.
Will be the constant
so if
rate.
There is any interest or return, it's just to keep pace with inflation, and that's going to form the basis of this. Because some of them just put in, just consider the interest rate, but they don't not adjust the interest rate. They do not adjust the interest rate. We have the nominal interest rate and we have real interest rate. Majority don't know that.
So the nominal interest rate is the rate that the bank or the kind of
the financial institution
you're using gives you as the interest rate.
Yes, as the interest rate.
Then the real rate is
it's you to calculate that.
It's now you to calculate to get the real rate that your money is earning.
You need to calculate the real return. Okay, we have nominal return and real return. So you have to adjust. So that is the knowledge that you want to give them. How can you come up with that?
You want to show us that?
Yes, I have to show you here. Okay. Actually, I upgraded. So you just bring that so that we can show them. But before even we show them, we should tell them the importance of why should you consider inflation element when making your investment decisions.
Tell
now,
us.
One is that sometimes if you just focus on nominal interest rate, you can end up not even beating the inflation.
Okay.
And that one, you are going to suffer some danger, and I want to show you that. So just bring that one so that we can show our audience.
The first one you said you may not be beating the inflation rate.
That is the most important thing.
Two?
When you don't beat inflation, then it means you are making loss. It means that you are losing the value of your money. The real value of money is going down. So you are not saving.
You see,
Yes.
I've also seen how inflation affects people, people's life. Assume that you get employed at getting a salary of maybe 100,000.
Yes.
And then within a particular period of time, you may find, because some employers take time before they review
Yes.
the salaries of the employees.
Yes.
So let's say in the beginning of the year, you've started by 100,000 as the income or the gross salary. Then by the end of the first year or the middle of the second year, you're still earning the 100,000. My assumption is within this period of time, there must have been inflation.
Yes.
So chances are the purchasing value of that 100 may not be the same as it was when you are starting.
True.
Right?
True.
So that should also guide you on how you can put your planning and help you to guide how you can negotiate for your salaries.
So that's why I'm saying the main issue there is the real interest rate. Okay, or the real purchasing power of that money. That's what really affect people. So anytime that you're making investment decision, what should come first in your mind is real interest rate,
Interest rate,
real return, real rate of return. That one you must factor in.
Okay.
Anytime that you're making investment decision. So I just wanted, if you say things like inflation, there are those people who don't understand this thing. So we want to illustrate to them. So you'll just help me with the board so that I show them.
I have one more question for you.
Yes.
To a layman who doesn't understand what inflation is,
Yes.
what can you tell them?
So inflation is just it's just when we say the purchasing power of money is going down, or when we say that there is a rapid increase in prices.
Cost of commodities.
Yes, that is actually the prices. So when the prices are rising, the consistent rising in prices, that is called inflation. So if the price rise, then it means you will use more money to buy a particular commodity. So that's why we're saying the purchasing power of money is coming down. If you have 1,000, you will buy few stuff compared when the inflation was not there or when the inflation was less.
So if I use an example is...
that's why I want you to bring that one so that we can show them how commodities practically, they won't see. Here
it is.
Yes. Just bring it so that we can show them actually how this thing. You see, these things, if you just without showing people,
they may not get it clearly.
They may not get it clearly. So let's just show them. I hope it's okay.
Yes, you're good.
Okay. So today we talk about inflation.
Just tilt it back. There's a bit of reflection.
Sit this way.
Yes.
There.
Yeah. Just maintain it like that.
So you okay?
Yes.
So we are saying, for example, we have 1,000. We have 1,000 Kenya shillings.
Yes.
So if you have 1,000 Kenya shillings, that is, let's say, for example, last year 1,000 Kenya shillings. Last year January. 1,000 Kenya shillings. What was the price? Please, you can just help me with this one. I want us to show these people real thing.
Yes.
Look for me. What was the
please
price?
Please help me here. It's asking me for the fingerprint.
So what was the price of sugar in the year 2019? Good. 2019. What was the price of sugar in Kenya 2019?
Quick one, just a moment.
Yes. Price of sugar, 1 kilogram.
Well, towards the price of
sugar. What was the price of sugar as of 2019?
kg.
Yes.
Sugar in Kenya. 2019, right?
Yes.
Okay.
What are you getting?
So in 2019, the average price of 1 kilogram of sugar was going for at least 116.
It was 116. So it was 116, eh?
Yes.
So sugar was going at
1 kilogram was 116.
116.
116. Yes.
So that is, this is
sugar
2019. All right. So 2019,
that was the price.
This was the price of sugar.
Yes.
So let's assume that you had this 1,000 in 2019. Okay.
How many sugar could I have bought?
So
then?
how many packets of sugar could you have bought with that?
That's
So
1,000.
just say what, 1,000
I divide by
divide by the
116.
price of one sugar.
That's roughly 8 kg.
You would have bought it
But roughly 8 kg.
8 kg.
Yes.
8 kilogram.
Yes. It's
Okay.
8.6, but let me go
So
with 8.8.
so 8 kgs.
Yes.
Now to date, okay. Today, how much 1 kilogram of sugar cost?
A quick one. 1 kilogram of sugar.
We bought
average today costs an average of 136.
136. 136.
Yes.
So I want you to do the same calculation. So 100. We have 1,000, the same money. So divide by 136. What are we getting? How many kilograms are you going to buy?
7.
So you are going to buy
7 kilograms.
7 kilograms. Now, this is what we are saying. You have lost 1 kilogram within the period.
Yes.
This is just an average, but this is now what we call, so because 1,000 in 2019 could give you
8 kilograms.
8 kilograms. But now, this is now in
2025.
2025. In 2025, the same amount of money, it's now can only give you what?
7 kilograms.
7 kilograms. 7 kilograms.
This is now what we call inflation.
But you say that 136.
Yes.
Can you multiply that by 2?
136 by 2. That's what? 136 by 2. That gives you 272.
So you've just taken average. There are some brands that are real. You can even buy up to 350. Yes. So this is just an average. So this shows you. So that is what we call inflation. So you can define inflation in 2 aspects. One, you can say the purchasing power of money has gone down. Or you can say the price has
arisen.
So the rising of prices, that's what we call inflation. So anytime that if you're supposed you had this 1,000 and you are planning to use this 1,000 today
to buy the same
to buy the same number of quantity of commodities, what you must ensure that you put this money into an investment or into a saving account that will maintain the value of that
value, so that by the time it comes to this period, it will still be able to buy 8 kilograms.
It's supposed to
sugar,
still
right?
give you this amount. You understand?
Yes.
So it means if at this time you are supposed to buy what? 8
kilograms.
8 kilograms. So it means this money, it's supposed to be equal to what? So multiply this times the number of sugar that you would have bought. So
as of that time,
the packets that you should have.
So that's 136 by 8. That gives you 1088. 1088.
1088.
Yes, 1088.
So assuming you wanted to maintain the number of commodities that you want to buy, then at least we are just putting in the context of what?
Sugar.
But you understand that inflation, these commodities, they usually differ in terms of inflation. Prices. You might say that sugar has risen to this, then other food stuff also
have risen by a particular amount.
Yes. So that's why we usually use the general inflation rate. So that's what we want to get into. Okay. So at least now these people, they know what, if you talk about inflation, what are we talking about? An average person, they are viewing us. If you talk about inflation, we're just talking about persistent increase in the prices of what?
Of commodities.
When we talk, or we can say it's the declining in the purchasing power of money. Yes, the value of money is coming down. Very nice.
Okay. So what we are saying, in other words, when you now define investment, it simply means that the money that you're investing, by the time for you to call it an investment, it should be at any given cost, it's beating inflation, right? Secondly, it's giving you an interest on top of that, right?
Use return.
A return. So assuming this was an investment, as of this time, at least this should be the the value of that money, and then giving it I'm assuming a return of maybe 12 shillings, right? So by this time, I'll have at least 1,100, right?
Yes.
I should have at least 1,100 to call this an investment.
But this is not ideal because we have only used one commodity.
Yes, I'm assuming I'm investing.
Yes.
I'm assuming I'm in that investment.
So if you're assuming an investment, you should use general inflation rate to calculate that.
So that's where we're headed to.
Yes, that's where we're headed to.
Okay.
So anytime that you are making an investment decision, you must adjust the inflation, you must adjust that return or interest rate. You must adjust it to what we call real interest rate. You must adjust that. Now, how do you adjust that? You use what we call Fisher's formula.
Fisher's formula.
Some people usually say, you see, by the way, some people, if you tell them adjust the inflation, let's say, for example, currently inflation is at...
using an example of Kenya.
The inflation for, yes, using example, let's use the example of Kenya.
That's 3.3, right?
That is the inflation for the last month. Last month was January. So the inflation for January was 3.3%. Okay.
Yes.
So in Kenya, they usually release this inflation rate after we have closed the month.
Yes.
So like the previous month was January. So the inflation for the general inflation for January was 3.3%.
Yes.
You understand? So it means when you are making investment decision currently, you are supposed to factor in this.
So this should be the inflation rate that we're using.
Inflation in December was 3.
It was 3.0.
It was 3.0. So December was 3.0.
Yes.
So this was December
2024.
Okay.
Yes.
I want us to go back a little bit. So, and November, what was the inflation?
2.7. 2.7.
So November. So 2. November it was
2.7.
2.7. It was 2.7.
I'm seeing a constant increment by 0.3.
By 0.3.
Yes.
0.3. Okay. So these are very important for you when you want to make decision. For example, you want to invest now, and if you look at the trend, it is increasing.
Yes.
So if you want to make an investment decision for this month, we can say that if the trend remains constant, then inflation in February would be
3.6.
3.6.
Yes.
You understand?
Yeah.
So as we call them astute investor or seasoned investor, you are supposed to be having this one in mind. So when you want to look at the rate of return, the required rate of return, you must adjust using this. You understand?
That is seasoned investors.
Seasoned investors, experienced investors, technical investor. You can name it. Yes. So if you are such an investor, you're supposed to be having this one in your mind.
You should be able to see the trend and know that you are expecting it to either increase by that.
Yes. So this is based on is an estimation.
Yes.
We are not yet there. It can come down or it can go up. So let's just use the current one.
Yes.
Let's just use the 3.3 to do this. So I want to talk, for example, you are considering investing in a fixed income fund.
Fixed income fund.
Yes.
As a sample of the vehicle that you're using. Okay.
Yes.
Bring it on.
And the fixed income fund is giving you, for example,
2025, right? Don't remember the.
Oh, sure. Yeah. So you want to invest in a fixed income fund.
Okay.
And the fixed income fund, you've been given the rate. Now, viewers, I want you to be very keen on this. That rate that you've been given, or the financial institution, all that wherever you want to invest, the rate that they give you is what we call nominal rate.
Nominal rate.
Yes, it is called nominal rate.
The financial institution is giving.
It is gross of inflation. It is gross of
inflation.
Those terms are very important. Yeah, as an
gross,
investor,
it means it's including.
Yes, it is including inflation in it. So you're supposed to net inflation
So that
So
you
when
know
you
the
net
rate you
inflation,
should
you
use.
come up with real
Rate.
interest rate.
Okay.
So I wanted to explain something that some people do this mistake. So this is a mistake. Record this. If, for example, if say money market is giving you, let's say 13.07,
Point,
07,
okay, 07.
percent per annum.
Per annum.
Then you know that inflation rate is
0.3. I mean
3.3. Okay.
Percent.
Annual. This is annual,
Per annum as
per
well.
annum as well. So some of us, which I don't blame you, they do deduct this thing direct.
So they simply take 13.07 minus 3.3.
13.07.
That gives you a
Then-
10 point what?
Then they
10 point,
they subtract. Just get the actual.
13.07 minus 3.3. Oh, it's a 9.77.
You are getting
Was that borrow forward? Yeah, 9.77.
9.77%.
Yes. Yes.
So they do this, but this is having some flaws. Don't do it this way. It's not just being subtracted arithmetically like this. There is a formula that's supposed to give you the actual figure, and we want to illustrate this
So
one.
to somebody who is not a seasoned investor,
Yeah.
you would say that you is the one who will take 13.07 minus 3.3.
I would say that about 70% do that.
Ah.
Yes, about 70% do that. That's what they believe. By the way, not even just seasoned investors. Even there are those people who are from accounts background and they still do that. They just subtract and they say now.
Now you know, guys, right? You
So
don't do that.
they
directly.
still don't know what's supposed to be done. So this is what you're supposed to be doing. There is what we call, there's this big man here called Fisher. So Fisher came up with what we call Fisher's formula.
Who is the next Fisher?
Fisher's formula. So this Fisher's formula is what you should use to adjust nominal interest rate
To
into
real
real interest
rate.
rate. Okay? I want us to go about it. So Fisher says this, that 1
If you take 1,
plus
you've
R.
given a dot there. They may think it's an I. Make it a 1.
Oh, sure. Let me just come up again.
It should be
So
1.
say 1 plus
R.
R. Okay.
Then 1
1
plus
plus
I.
yes
Is equal
equals to
1 plus N.
plus N.
Yes.
I'm seeing you're becoming a seasoned investor. You're becoming
I
a
am.
seasoned investor. You're becoming a seasoned investor. That's nice of you. Now,
So we still don't even understand what IRN
yes,
here
so
is.
I'll say that R stand for real interest rate.
So R is the real interest
Real
rate.
interest rate.
Yes.
So we
Real
can just say
interest. Yeah.
real rate.
Yes.
Okay, real rate of return. Then I'll say we have I.
We have I
So I
is the inflation.
is the inflation.
Inflation rate.
Yes, it's the inflation. Of course, it is rate. Then N
is the nominal rate now, right?
N is the nominal rate.
Now this is the rate that the bank gives you, or the financial institution
Yes.
that you're investing at gives you.
So I think they've understood. So we are saying that R is the real interest rate, I is the inflation, then N is
Nominal
the
rate.
nominal rate. I hope this view is clear. You can just confirm.
Yeah, let me confirm.
Yes.
If the view is very, very clear. Yes, the view is clear. I may even zoom for us so that we can see it better. Yes, I think it's okay.
It's okay, yeah?
Yes.
Good. Now, due to my board, I've told them what N stand for. Yeah.
You can even leave it. You can proceed. Yes.
Can I just proceed here?
Yes.
Is there visible?
Yeah, it's visible.
Okay. So, we want to make R the subject of the formula.
The real
we
rates.
want to simplify this formula so that because this might be for those people who fear maths, it might scare them. So we want to simplify this so that we come with something that is precise.
Something simple that they can
simple
simply
that they
use
can
directly.
even cram.
Yeah. Good,
Okay.
Good.
So let's simplify this together. So we are saying that there are people who say that where will maths help me?
And you want
It's
to be
now
an
here.
investor.
It's now here as an investor.
Here
it's
you
now
are.
here. Okay.
And by the way, you see, if you don't want to master all this, then you'll have to hire a financial advisor to help you with this simple stuff that you can do by yourself.
This one does not eliminate financial advisor. Yes.
But at least when I'm in
But at least when you come,
advisor,
we call you a technical investor. You see, dealing with the technical investor is not
because
easy.
that person is informed.
He is informed, so you cannot mislead that person.
Very true.
Yes, that person just need you to affirm some things. You understand? But he or she knows what he's looking for. Okay?
So
but if you're non-technical, you will just even fumble and give wrong information.
And that will also help you if you are a technical investor. That will help you to gauge the financial advisor that you are seeking.
Yes.
You can tell that this one,
Yes.
I may not pick this one, right? Because you are at least informed.
Though nowadays they're eroding the name financial advisor.
What are they using?
They're eroding it.
They're making it look...
Because they started bringing in people who are selling insurance policies. They are calling them financial advisors. So they're eroding this. So that's why
you see, I had an
I'm a
argument.
finance analyst. I'm not financial advisor.
Okay, finance analyst. I hear some people are bringing the argument that these people who are called financial advisor, they are so good at advising you what you should do with
Don't get into that. Don't get into that. Now let's get to this.
Okay.
Let's get.
Okay.
It's up that they have information. It's when they're in the process also
But
of making.
but
what? That's what.
why don't they use the same information to
See,
help?
they're in the process.
Really?
See, they're helping you. They don't want to make it. Is when they start helping you. So you grow together. Okay, get back to this. Now we are saying that. So going back to mathematics. So I'll break one bracket.
So the goal is to make R, which is the real rate.
Yes, I want to make R the subject of the formula.
The subject simply means it's on the left side of the equation, right?
So what I'll do, so let me just break this. I'll say 1 into
1 plus I.
plus I, right? Plus R into
R plus R.
Of course, this was just the same. 1 plus I. Okay?
Yeah.
That one is equals to
1 plus N.
N.
Yes.
Okay?
Yes, yes.
So I want to break this one. So this one, this times this is 1, 1, eh?
Yeah, 1 times
so that's
1
remain 1 plus that one remain I. So we are here.
Yes.
1 times R
is R.
So plus R. Then R times I
is R I.
plus R
I.
R I. So I think the flow is good. They are seeing this. Those people who are interested in deriving this formula, this is how we go about it.
Yeah, you can also challenge your what?
Challenging what?
IQ.
This is correct.
They challenge their IQ.
The IQ.
Yes.
Oh yeah, they can just you can just post the video and do what? Derive this.
Make
then
R the subject.
yes, and confirm whether we will get the right answer. So 1 plus
N.
N.
Yes.
Right? So here so here what are we going to do?
Because we are aiming at making R the subject. I'm seeing R's are common here.
Yes. So let's how do we say we expand or we do what?
What
we are going to take it back to,
you can maintain it as it was here.
Yeah, it's going, there is what we call expansion and what?
I don't know the opposite of expansion.
It's usually expansion and simplifying. You expand and simplify.
When you're expanding, you're simplifying. So this is the simplifying. Then the reverse, whatever. Maintain it here.
Okay. So, not just maintaining. It's still, if I do that, it will still come back here.
Yes.
It's this, an opposite. If you open this one, we have opening and expanding. Or what's is it opening and expanding?
You see what you've done
Yes.
is the expansion.
So that is the expansion.
Yes.
So the other one is?
The opposite of expanding?
Yes.
I don't know.
Okay, so right. So we'll say we have 1 plus I
plus R
plus R into 1 plus I, right?
is equal to
is equals
1
1 plus
N.
N, eh? So we are here. So what I'll do, I want to collect the like terms. Eh? I want to bring this, I want to take this one the other side. Eh?
So you are taking these two, this other side.
I take the 2. Eh?
Yeah. So you and
Right?
then you remain with R.
Yes, so I'll remain with R here. So I'll say R is equals to.
No, you'll take R into 1 plus
See, I'm just sure. I'm just copying this. I just want to copy this. Plus 1
plus I.
in this is I, yeah?
Yes.
So that we don't confuse.
Is equal to.
Is equals to
Now bracket 1 plus M.
1 plus
M.
no,
Oh,
it is
N.
N. Let me make it N. 1 plus N.
Close the bracket. Minus. Now because
So
this is 1, it's a positive, right? So when it comes
So
to
let's
this side,
just
it
say-
becomes minus 1.
What if I just say this? I'll complicate issues.
Some people may not understand how you
I will explain to them. I, eh? This is I.
Okay.
It's right, eh?
Yeah, that's right. But some may not understand how you.
They are not understanding.
Yes.
What I've done, this is, let's assume we have a bracket here. So I've just taken this one the other side. But being that all of them were positive, so I must introduce negative sign, because when you cross the other side, it becomes negative.
Yes.
Right?
Yes.
Then, what are we remaining with here? So you can see this one is, okay, we want to remain with
So
R.
this is a bracket, eh? You're
Yes.
writing it like a C.
Okay.
Make it a good bracket.
Okay. So we are having, we want to remain with R here. That is the main goal. Eh? We are almost done with it. So we just divide both sides by 1 plus I. So
Divide this one
let
as
me
well.
just, because if I do that also I'll confuse some. This one also.
Yeah. 1 plus I.
Right? So you can just do this. Right? So this one,
Cancels that.
cancel that. Then
this one is the same as this.
this is the same as this. So we can just cancel this. We are remaining with negative 1.
Negative 1.
So R
Is equal
is
to
equals to 1 plus
N.
N over
1
plus
I
plus I minus
1.
1.
So this is the formula to calculate the
Mathematics.
real rate.
So this is the formula. This is the simplest form of Fisher's formula that you will always use to calculate what?
The real rate.
The real rate. So this is what you use to convert the real rate. So this is what we're going to apply. Okay. I hope they have noted this.
Yes.
So it is I mean 1 plus N
So this
over
is 1.
Yes, that is 1
Let's say 1.
plus 1 plus
I.
plus I, yeah,
Yes. Minus 1.
minus 1. So this is what you, if you don't want to go all through this, if you don't want to go through all this, just master this. 1 plus N over 1 plus I. Then you should always know what this one means. So according to us, we say that R stands for real rate, I stand for inflation rate, then N stand for nominal rate.
So in
Nominal
other words, you are saying it's also okay to call this one Fisher's formula.
This is Fisher's formula, actually.
Yes, because we've just derived it.
It is only this one that we have just simplified. Yes. So this is Fisher's formula. You can't take this formula and say it's yours.
This one is my formula.
No. This is Fisher's formula.
But I've added this one. to
No,
make it
that
work.
is just simplifying whatever is there. So this is still for Fisher.
Fisher's K formula.
Yes.
Yes. The K is me.
No. Now let's go to the let's now use this and use this to adjust the rate that we had the other time.
Yes.
So
So
we can
to simplify, maybe you can just rub these. Let me help you with rubbing, so we maintain what R and whatever mean.
good. Nice. So we are just going to use substitution here. We say that N, which is nominal rate,
Is the rate that the financial institution will
so
give
and
you.
we say, for example, in our case, we say that it is what?
It was 13.07.
13.07.
Yes, percent. Yes.
Percent, per.
Annum.
This is very important, by the way.
Yeah.
Some financial institutions use this one to make you think otherwise.
They make this per month.
Per M, per month, they say PM, and you don't know that PM. You still conclude it is per
year.
per year,
Or per annual.
and then you say this loan is very cheap.
Can you
Okay,
imagine?
it is 1%.
It's just 1%. This is crazy.
Okay, so let's get back to this.
Yes.
So what we are going to do, we'll just substitute this one here. So we say R is equals to, so 1 plus, this is percentage, of course you divide by 100, so it will be
So
0.
you divide that by 100.
0.13.
You simply move the 2 dots.
Yes.
Right? The decimal point, you move it back with 2 decimal places.
Over. Inflation, we said that it is
3.3%. Yes.
So that one will also be 1 plus,
plus
0.033.
Then
Minus
1.
Right?
So this is for fixed income fund.
Yes, we are using this rate. You are going to make decision. Okay, this is the nominal rate. Okay,
For institution A.
yes, but after factoring in inflation, what is the actual money I'm going to get as a return? Okay, because we have, and by the way, after adjusting this one again, you adjust tax. you adjust withholding tax. We'll do that so that you get to the actual money that you are going to have. To have. Yes. Now, help me with this.
Do this quick.
So we have 1.1307.
1.1307
divided by 1.033
gives me 1.09457. 1.09458 or 456.
456. This way.
No, this should be 6 because we are maintaining 4 decimal points.
46. 0.946. 6.
Yes.
This way, eh?
Yes. But we
just make it. I want you to make it. Just make it 6.
6.
Make it 5. Make it 5 because we are going to multiply by 100. So it is
make it
4.
5. 458. 458.
458.
Yes.
This way.
Yes.
Minus
1.
Of course, this one will go with this one. So we are just going to remain with
0.09458.
458.
Yeah.
Then this is not percentage. So if you want to get the percentage,
you multiply
this one by
100.
By 100.
So that moves the decimal.
So
back
we are going
again.
to have
9.458.
458%.
Yes.
So this is the real interest rate.
Not the 13 that.
Not this one. This is gross. So when you're making your decision, don't use this one. Okay? Always don't use this one. This is gross. Because the money you are going to get from this is not adjusted to the inflation rate. And we've shown you in the previously we've shown them that in the earlier part of the video, we've shown them that inflation is real.
Yeah.
Because if, for example, if you are buying a soap, a bar soap at maybe 100 Kenya shillings, and currently you buy it at maybe 180, You see, when you go with that your 100, you should not buy it.
Yes.
You understand?
Yeah.
Because the price has increased. So that's why this is very important. This is not just theoretical, it is very important. So this is what will tell you what have you earned actually. Okay? Because this one, part of it is going to cater for inflation.
When you use this, you may get high return.
Yes.
And then you think that
you might deem it. You are just deeming it. It's not
you may
high.
deem as if you may deem it as if it's high.
Yes, but it's not.
And then the return you'll be getting won't be the actual return that you'll see, right?
Now, after getting this, I want to go to tax. Okay? In the context of Kenya, these investments attracts what we call withholding tax.
Withholding tax.
Yes. So withholding tax in the context of Kenya is 15%.
15%.
So in your country, you can know what is your withholding tax. So what you need to master is this. And this, you can apply it universally. Okay? You can apply it wherever you are. So what you have to master is what is the inflation rate for your country.
And then what is the nominal rate?
And what is the nominal rate? Then you calculate. Then when you come to tax, what is the tax applicable? What is the withholding tax applicable in your country? Then you do the same thing.
But okay? if I don't know if I'm not getting it right. If my real rate is 9, then withholding tax is 15. Is 15 not greater than 9?
No, you don't do it like that. So that's why I said that you also need to there's how you adjust.
So there's a way you adjust withholding tax.
Yes, you there's a way you adjust withholding tax. Okay. So this is how you are going to go about it. So we are done. We so note that one here. So we are saying that real R is equals to 9.458. So we want to adjust this one. So we want to get after tax the amount that you are actually going to get in your account.
Oh, you're not erasing this.
This one, or we've just applied it.
So we want
let's just leave that. Let's just rub it here.
Leaving it, okay. And then write it
rub here. So if you want to adjust tax, what you do, for example, if you say for Kenya is
15%.
So if you say 15% is tax, and total percentage it is usually 100%. 100%. So if you want to get what you are going to take home, subtract this from this.
85.
So you are getting yours is
85.
So 85. Yours is supposed to be 85%. So government will take 15%. You will take 85%. So what you will do, the 85% just means 0.85. So you multiply with your rate. 9.458. So what you are going to take home is what?
9.458 by 0.85. That is 8.0393.
That is
8.0
8.03 93. So this if you estimate, that one will be
8.04.
8.04. Now this is per annum. This is per annum.
So in okay, to our viewers who are going to calculate the return that they're expecting.
Yes.
Should they use 8.04 or 9 point?
Now there's also something I need to tell our viewers. People don't know these things. They think that how they do calculate these things, when you are learning and class is the same as the actual one. It is very different actually. So maybe should I extend and show them?
Yes, please.
How they can now convert this one into money. How you can now get it money. Now most of financial institution, and that's also bring the difference between fixed income fund and when you save in a bank.
Fixed income fund and saving in a bank.
You see, banks don't compound interest. You understand?
Yes.
So for banks, if you just have this is what you multiply with your
capital.
So
they're using simple interest.
So this is what you multiply with your capital, and that's what you will actually get at the end of the month.
At the end of the month.
At the end of the year.
Yeah, because
and if it is monthly, you just divide this rate by 12.
By 30. By 12.
Yes, then you multiply by that. But being that we'll explain that in the next episode. But being that we used fixed income fund, fixed income fund usually is compounded monthly. And when we say you are compounded monthly, it means that you get the interest for the first month.
We add it to the previous capital.
We remove tax. We add
the net to the capital, the closing capital balance.
Just like that until the year ends. So to simplify this.
So in other words, if month 1,
we want to do that.
Okay.
So I believe all of you have understood what we have done here. This is the actual thing. So you see the gross interest rate was
13.07.
13.7.
07.
07. So this is what you were told that is the interest rate actually. So some of average investors usually calculate this. Then they say that why were you giving you, this is not translating to what you promised.
Because maybe when they look at their returns, they don't see that tallying with the expectations.
It is not tallying with the expectation. You understand? Yes. So it's very important to adjust this. So we've done 2 adjustments here. We have just adjusted for inflation. Then you also adjusted for tax. So that is the ideal investment. So this one should help you when you're making decision. Okay. So you take all those rates, then you adjust them for inflation. Then the higher you go with the higher.
The highest. So what you are saying is, before we proceed, assume I'm having institution A, institution A and institution B. I hope I can write and my guys can see. Institution A and B.
Let me just write bigger. A
and B.
And B.
So B happens to A gives me 9.4, right?
This is adjusted.
Yeah, this is adjusted. Then institution B gives me 10.2 as adjusted. So it means first, this is the one that I should go for.
Assuming that things are the same. Assuming that factors are constant.
Yes.
Because sometimes there's an institution that will promise you this, but it's just an incentive. But there's something they are not telling you.
They're cooking something that I'm not aware of.
Maybe they've been involved in frauds.
So it is also important to check the background.
Yes, you need, when you're making an investment decision, you need to really check on historical performance of that financial institution, and also check on their balance sheet, such that in the event that things turn out worse, then but their balance sheet is strong, such that they can support what? They can pay the investors from their own holdings or the holdings in the company. But if their balance sheet is not strong, then it means when they loses, you understand, that's where the importance of that word limited liability.
Yes.
So the company itself, is it having enough money to take care of
its liabilities?
Investors claim in that company. You understand? So we have a lot that we can really talk about this. Let's now show them how we can now go directly. So we say that this is what we have, yeah? This is, I will just use this real interest rate, assuming tax, because I want to show you how tax is usually being calculated when you adjust this for taxes. So let me just erase this. I think even this one I can just erase. Yeah. If you want it back, you can just go back.
No.
Go back to the video is there, so they can just go back and reflect on the same.
Okay.
The video is there. You can just go back. All right. So we are saying that now real interest rate
is 9.458.
Real interest rate R is 9.458%.
per annum.
per annum. This is very important. And for example, you say that it's compounded monthly. If you are told that it is compounded monthly, so it means when you want to calculate this thing, I want to calculate up to the third month. Assume you are investing how much?
An average of
1 million.
$10,000.
No, don't go to dollars. Don't go to dollars. Let's just
an average of local currency.
Yes.
Give it 1 million. Yes, 1 million.
1 million. I will, that one will scare viewers who are less than 1 million.
500,000.
Let me just use 100,000.
100. Okay.
Yes. Let me use 100,000. So let's assume you are investing. You have 100,000 that you want to invest. Let's say like this. So your capital is you have 100,000 and you want to know month on month how much should you expect in your account. You understand? And I think we have two things. You see, when you say gross nominal interest rate or return, it does okay. You see, when you use this, amount will be lower. That is the real interest rate. But again, the amount you will actually receive in your account is more. So the amount you will receive is calculated based on gross. You understand? So this the importance of this real is just to tell you, out of that money that you receive, which one is real. You understand?
Where are the rest? Why are the rest not real yet?
They are not real because the prices have also increased.
Oh, the inflation.
You understand? Yes. So I want to calculate using gross, then I calculate using real. You understand? So the difference will be the inflation.
Okay.
You understand?
Yes.
So let's start with, so this is real, then let's go nominal was 13.07%. I want to start with, let me divide this into two. So here I want to calculate real and nominal, then here I will calculate real.
Okay.
So month one, in the first month, what you do is this. Of course, we usually say that you take principal, you multiply by
for nominal
rate over what?
Time.
Over 100 times.
Over 100 times I,
T,
which is time.
time. So what we do, first of all, we have principal, which is 100,000. So the most important thing here is adjust this one. Make it
Real rate.
no, make it the monthly rate. So you divide this 13 by 12. So 13.07 divided by 12, what are you getting?
That gives you 1.08.
1.08. You're getting
1.0892.
So because of I don't want to consume a lot of space, that is percent.
Yes.
So convert it into it is percentage. So it means you divide that one by 100. Remove
that
it.
gives me 0.01.
0.01
0.0889.
0.01089.
Yes, yes.
So this is
The monthly.
return.
Yes.
Okay. Then of course we multiply by 1 because it's that month. So here we multiply by the principal.
Which is 100,000.
Which is 100,000. You understand?
Yes, yes.
So that one would give us what? Help me with that. So multiply that.
Multiply
100,000
by 100,000
by 0.01089.
That gives you 1,089.
1,000?
And 89.
1,089.
0.17.
1,089.
Yeah, you can leave it at 100. No, it's 1089.
1089.
1,089.
Those are decimals. Those are cents.
Okay.
They are money.
1089.17.
17.
Yes,
So
yes.
87 cents.
17.
17.
This should be 1.
Okay. 17. So 17 cents. Let's assume this is
Kenya shillings.
Kenya shillings.
Okay.
What am I writing?
Kenya shillings.
Good. Okay. So we have 1,000.
Yes.
So
In
that
month
month, if you invest 100,000
in the first month
and the interest rate
is
per annum, you've been told that is
13.07.
13.07% per annum. This is what we should expect in a month, but this is gross. Okay. So this is what we adjust. This is what you use to adjust for taxes, because every month you have to, that withholding must be deducted. Okay. So this is what now, for you to get the net, this is now gross of tax.
So it is 0.87 by that.
Yes. So it is 8.05. So this is gross. So net would be is equals to 0.85 times 1,089.17
times 0.85. That gives you 925.
Let me just squeeze this thing to fit on this other side. Say 0.85 times
1089.
1089.17.
That gives you 925.
Give Kenya shillings. Give me
925.
925.79. 79.
Yes.
So 7 cents. All right. So the first month, this is what you are supposed to get. This is what you should get you on your account. This is the money that will come in your account,
which still is not the real money.
So this is gross.
This is gross.
This is nominal
it was calculated
return
on the nominal rate.
Yes. So this is gross. So actually you have this money.
So it is
but if there is inflation, this money, which is the its purchasing power is less.
So if you compare this money with a particular period of time, maybe a year ago, what this money could have done is more than what this money will do now.
Yes.
Because this is inclusive of...
Yes, it's inclusive of inflation.
I get it.
Yes. So this money will do less currently. But previously it could do more. Or it could have purchased a lot of stuff. You understand?
Yeah.
So that is the difference. So I'm explaining how we calculate return
Yes.
for fixed income fund.
Yeah.
So this is actually what you do.
I've arrived
now. So this is the first month. So when you go to the second month, assuming that you only deposited this, you are not adding more. You are not adding. You are not.
I'm not topping up.
You are not topping up
capital.
So it's just the capital. It's just the capital that you invested. That's all you have. So we continue with this. So we take this one. This now what you take. You add to what?
To the 100,000.
To the 100,000.
That is in compounding interest, right?
Yes. I've said that fixed income fund is usually compounded on monthly basis.
Okay.
So, but other financial institutions might even compound quarterly, and quarterly that means after 3 months.
3 months.
Then some can be semi-annually. That's our after 6 months. Others can be what? Others can be what? We have quarterly,
we have the
semi-annually,
annually, we have annually,
then we have
the tri-annually, the termly after 4 months.
Termly
after 4 months.
After 4 months.
Yes.
Right? So something like that. You need to understand that. So when you are
the next month, it simply means that the starting capital.
So next month, the opening balance.
Yes.
So it means that this month the closing balance will be this one plus this one. So that one would be
100,927.79. So 100,
so
comma 925.
so this, let's just say opening balance. So closing balance is equal to opening balance.
Yes.
If you don't
Do a
top
top
up, so opening balance, opening bal will be
100.
so 100,000
925.79.
79.
Yeah.
So that is the open. So this is what you are basing your calculation again. Okay.
So
you
when you're coming here,
so you just
now
come
you'll
here.
start with-
We say that this is the rate because it is constant. So this is what you multiply by this.
By this
So
to
you just
give you-
say 100 92517. I mean 79 times
0 point
0.018
no 108
0.01089.
1.0108089.
What are you getting?
That gives you 1099.
10.99.
Yes.
So you're getting 10.99.
Yeah. Which is good compared to.
So 10.99.
Oh, I should multiply it again with the.
Will this is not yet adjusted to tax. This is gross.
So again multiply by 0.
But before we go there, I want to explain to them the impact of compounding. So in the first month, what was the interest rate?
The interest the same. The
Gross.
rate was the same, but the gross
Gross was this
was
one.
1089.
10.89. This is 10.99. They are not the same.
Yes.
You understand?
At least there's a 10 shillings that has
Has been
added.
added. You see, 10. So that is the importance of
So
compounding.
the bigger the capital,
Yes.
the bigger the effect.
Yes,
of
the
compounding.
bigger the effect. That's why they say that compounding is the eighth wonder of the world. Compounding is the eighth wonder
Of the world.
Yeah. So it has
Not
impact.
10th, why
is-
just 8?
That's how it is. That is
Okay.
in terms of wonders when they are being arranged. It is the eighth one.
Ah.
Yes. It is the eighth wonder of the world. Okay. So after getting this, we adjust tax.
Yes.
So you multiply this
With the 0.85
0.85.
to get rid of the withholding tax.
Yes.
Then you'll have 934.
You're getting
934.
934.
Yes.
So you're getting 9.
34.22.
Okay. We are getting
934.22.
934.22.
Yes.
So that is 22 cents.
Yes.
So Kenya shillings. So second month, this is what we are having. So you see the first month we had
925.
925.
Now we
Second
have
month we are having
934.
So when you proceed with this thing, the more we can proceed, the more the effect is becoming bigger. You understand?
Yes.
The more the effect is becoming bigger. So when you, let's say for example, if we use the 11th month, you'll find that the compounding effect shall have performed the wonders. Yes. So that's why it's very important when you're considering investment. First, check, is it simple
or it's compounding?
It's compounding. So that's why you should sometimes you find that fixed income fund will rally with the treasury bill and treasury bonds
because of the compounding.
Because of the compounding effect. And when you look at the treasury bill, you will see that they're having, sometimes they do have big figures. Okay, so you might see that when you just look at the interest rate alone, you might make wrong decisions. So usually you need to go down to the calculation like this when you're making the investment decisions. So that's why we are doing this, so that you can know how to do
Simulation.
it. And when you do that, we call you seasoned investor.
Informed investor.
Now I don't want to go up to the.
No, I guess up to here
they can proceed.
They can proceed. Simple interest is known. It's easy.
Now, should we use real interest rate? I want us to use real interest rate so that we compare with the first one here.
Yes.
So that
So for the first month, we can note it was 925.
So we can just use this here. We can use this space.
Okay.
It's just this rate that we divide by
100.
By 12, then by 100. So we divide by.
So I get monthly first. That is 9.458 divided by 12. That is 0.788.
Yes, divide by 100.
Divide by 100.
We're dividing by 100 because it is in percentage. So what is
that
the
is
rate?
0.007.
So we have 0.00788. We multiply by the capital invested.
Which is 100.
That is 100,000. So what are we getting?
We're getting 788.
So gross return is
788.17.
788.17.
788.17.
So this is
this is the gross return.
Just a minute. So just say gross return is 788.17.
So if you compare these and this.
So this one was
1089.
10. So if you receive this, let's just proceed. So let us remove tax.
So we multiply that by 0.85.
So 0.85 times.
That gives you 6.69.
817. You get
6.69. That is net tax 6.69.
This thing don't want to write well.
669.
669.94. 94 cents.
Yes.
So this is in the first month. Now let's compare with the first month. So in the first month here,
it was 925.
So the actual amount of money you receive in your account is 925. But the purchasing power of that money is
669.
Tell those people that is what we call inflation.
So this
that is what we call inflation. This is very good, by the way.
Actually, what we are trying to mean is, if you are to use this 925 to buy something, its equivalent is 669.
Yes, this is the actual thing you have. This is the actual money you have.
But based on the period,
what it can do is equivalent to this.
What this could have done as of that time.
Yes. So that is what we call inflation.
And that is the importance of using the real rate.
That is the importance of using the real rate. You understand?
Yes.
Because if you don't use the real rate, you might think that you're investing, but your money is losing value. So for example, you see this one. This is the first value you are looking, but the actual value of it is this one. So if you look at your account, you're seeing you have 925, but the actual value of that money is 669.
So if we say this is just 1 month, so 1 month back, what 929 can do is equivalent to what 669 could have done this time.
Because this is annual, we have adjusted this using the annual inflation. This is 1 year back.
This is 1 year back.
Yes.
Oh yeah. Because you've used.
So let's say, for example, if you're in 2024. So we're in 2025. So 2025 February. So in 2024 February, you understand? In 2024 February, if you had this money,
what this money could have bought.
If you had this money in 2024, so now this is the value of that money.
It is the same as somebody who's having 669 today.
Yes, today.
2025.
Yes.
Wow. Inflation is real.
So if you put this one, if you invest, now if you invest, it become easy, because if you invested, for example, if you invested this money in 2024 February, then you're supposed to be having this now.
And if you didn't,
means
you won't hit,
then you're supposed to be having this.
You'll be having this.
Yes.
So you won't beat the
yes, you won't beat the inflation.
And your money won't increase. You'll still have the 666, right?
Yes. And that's why we are discouraging what we call under the mattress saving. Because the under the mattress saving, you are not going to beat any inflation. It means that you leave the money idle. When you leave the money idle, then it means, and it's not just under the mattress saving, also we can apply this to leaving your money in the current account. Still will this take place. But even it is worse, because
There now you're
if
being
you
charged.
incorporate even the
Maintenance cost.
the bank maintenance charges, will even reduce it more
Further.
Yes. You will reduce it further. So that's it. I think
that's good for today. Guys, we have Fisher's formula, and from today I'm adding my name into it.
Don't add your name. Don't do that. You just go introduce yours. Just go and do your own invention, so that we have to give Fisher his due respect. So Fisher's formula.
So Fisher is the king.
Use that to do what? Yeah, Fisher is the king as far as this formula is concerned. Yes. So that's how we do it. So guys, thank you. I think please you will be able to tell us if you've really learned something. But what we ask you, please learn, implement, and grow.
Beat the inflation.
Thank you. See you in the next episode.